In this video, we are going to cover what is compound interest. Welcome back to my channel, Numerics with Nadia, and let's get into our lesson objective for today. For today's lesson, you guys should be able to understand the concept of compound interest. We're going to learn the formula, as well as apply it to real-world situations through a few practice problems. If you guys haven't watched my last video on simple interest, I will go ahead and tag it right here for you guys. Before we get on to the rest of the lesson, I would definitely recommend watching that one first, just so you can understand the difference between simple interest and compound interest. Now let's get into the introduction to compound interest. Let's first start off by defining what compound interest is. So compound interest is the interest calculated on the initial principal and on the accumulated interest from previous periods. So there's a very important note here. Unlike simple interest, which only applies to the principal, compound interest grows exponentially over time because it is also on the accumulated interest from previous periods. I know this probably sounds like a lot. You guys will see it once we go through some practice problems, but let's also really quickly look at where this can be applied in the real world. So first off, banking and savings. This can be referred to as the interest earned on savings accounts and on fixed deposits. That would be compound interest. Also on loans and credit cards, right? The interest charged on unpaid credit card balances. We could also see it in investments in stocks, how money grows in stocks, bonds, and retirement funds, and also on mortgages and student loans. The amount owed increases due to compounding. Before we get into the formula, I would definitely write down this definition in your notebook, compare it to simple interest, and now let's get into our formula for compound interest. So here it is, A equals P times 1 plus R over N to the power of NT. And what does everything stand for? A is our final amount, including interest. Then we have P. P is the principal amount, your initial investment. Then you have R. R is the annual interest rate. And just like in simple interest, your interest rate always needs to be as a decimal. Then we have N. This is new and different than the simple interest formula. N is the number of times the interest is compounded per year. And then T is just the number of years. So write this down in your notebook, as well as what every single one of the variables stand for. And once you have done that, we will get into our practice section for today. A really quick note before we get into our practice section, I wanted to go over some common values for N. So the number of times interest can be compounded per year, it could be annually, which would be once per year, semi-annually, which is twice per year. Quarterly is also very common, that would be 4 times a year, and also monthly, which would be 12. And now that we've gone over some common values for N, let's get into our practice problems. The directions say to use the compound interest formula to solve each word problem. Number 1 says you invest $1,000 in a savings account that offers an annual interest rate of 5% compounded once a year for 3 years. We are asked 2 questions here. How much will you have after 3 years? How much would you have after 3 years if compounded semi-annually? So let's go through here. I already wrote the equation of compound interest out, and we're labeling our principal, our rate, our 2 values for N. We're going to do a side by side. We have when it's compounded once a year and when it's compounded semi-annually. So we'd have N equals 1 for part 1 and N equals 2 for part 2. And then our T value here, the number of years stays the same. So let's go ahead and do part A first. We have the $1,000 for our P times 1 plus our rate is 0.05, right? 5% as a decimal, divided by 1 times 3, because 3 is our number of years. Now we'll go through here and simplify. I would encourage you guys to simplify it before plugging it into your calculator to minimize mistyping or plugging anything incorrectly in. Once we do that and we calculate, we get our amount is $1,157.63. So this is how much we have, $157.63 of interest We add that to our principal. That is our compound interest. Now we'll do the same thing for part B. The only thing that's different now is now it's being compounded semi-annually, right? So here, instead of plugging in that n equals 1, we're plugging it in that n equals 2. So same exact steps. We'll go through here and simplify prior to plugging it into our calculator. What we will end up plugging into our calculator is A equals 1,000 times 1.025 to the power of 6. And when we plug in and do that, we end up getting $1,159.69 as our answer. So that wraps up number 1. We found compound interest both annually and semi-annually. Now we'll move on to number 2. Number 2 says you deposit $2,500 in a bank account that offers 6% interest compounded monthly, which means n equals 12. How much will you have after 5 years? So here I wrote our equation out. We know that P is 2,500. Our rate is 6%. We are given n equals 12, and here T is 5. So we'll go through and just plug in. We would have A equals 2,500 times 1 plus 0.06, 0.06 being our interest rate as a percentage. That would be divided by 12 because n equals 12 here, to the power of 12 times 5 because T is 5. When we go through and start to simplify, what we end up plugging into our calculator is A equals 2,500 times 1.005 to the power of 60. And when we go through here and plug this in, our final answer for our final practice problem is $3,372.13. And that wraps up our practice questions for today. I really quickly want to focus on a few key takeaways from today's lesson. First off, compound interest helps money grow faster than simple interest. And secondly, the more frequently interest is compounded, the more you earn or owe. And I have a graphic down here for you guys to be able to compare the two. And that wraps up our lesson for today. I hope you guys enjoyed the video. Please feel free to like it if you did. Comment any questions or any other video topics you would like to see down below. Subscribe if you haven't already. Share this video with a friend, and I will see you guys next time.